Okay, Eric, let's get into gold a little bit. You did this offering. Timing was part of the factor behind it?
Well, we had a good premium. There was an interest in it. We thought it wouldn't disturb the market.
This is for PHYS, Sprott Physical.
The gold trust, yes. We raised about, I think it was 320 million gross, something like that. Of course, you got to pay underwriter fees, so it'll be a little less than 300 million to us. And for the most part, we purchased all the gold. We may have another 20 or 30 million dollars to buy, but it's not a disturbing number in the gold market, as you know. I think South Korea, what they spent 1.7 billion on gold in the last 2 months. So, but I think gold's going to be incredibly strong here. I do the same thing with gold I did with silver, except I use my starting year as 2000 compared to 2010. I look at the dynamics of change in the market, and this is basically a 4,000 ton a year market with mine supply hardly having increased in a decade. And then you look at some of the big macros that happen. We have central banks are sellers of 400 tons. Looks to me like they'll be buyers of 400 tons. There's an 800 ton shift in the 4,000 ton market. You have the ETFs that started in, I think it was 04. And I don't have the number in the top of my head, but I think on average they buy something like 60 or 70 tons a year. I look at coin sales from the various mints. I compare 2000 to 2010, and they're up by factors of 800 and 900%. And I actually came up with a total, and I will discuss this at the GATA conference here, that we can identify 1,900 tons of positive change in the fundamentals for gold, other things being equal, in a 4,000 ton market. And I keep, scratching my head, where's the gold coming from, or who's not buying it in 2010 that was buying it in 2000? And it never makes any sense to me that there's so much demand and supply is almost constant. So I just got to believe that we're going to overrun the paper shorts, and in fact we'll probably have a physical shortage in due course.
Yeah, so there's so much paper gold out there, but only so much physical gold, and ultimately that's the driver.
Right. Well, we can see, when you see these central banks, I find it very instructive that the Bank of Korea's bought 25 tons in the last 2 months. And all I can think of is, what are the other 30 central banks around the world thinking? They see Mexico buying, they see South Korea buying, I think Thailand bought. Sooner or later, you're going to get other central banks that, we got to get in this game here. So I think there'll be a physical shortage for sure. We don't see much increase in the gold production. Most major mining companies are stumbling with production, so we're not going to get much of an increase this year.
Given that the spot market is both a function of the physical market as well as the paper market for gold, I wanted to ask you, because one of the things I follow very, very closely is, backwardation, whether gold is in a normal contango or whether the front month, the spot month, is above the futures month. And so far, it's remained a normal contango, spot and working on up. But if you look at a fund like PHYS, it's always trading at a premium to spot. Isn't that a form of backwardation in the sense that you're much closer to physical metal than a lot of the spot market is, because there's a lot of paper involved in the spot market?
Well, I think that a lot of people have a distrust of both the Spider Gold Trust and the Silver Trust, the SLV. And so they're willing to pay these premiums where they trust people to have the metal there, and particularly if they can have access to it, which in the case of our Sprott Physical Gold Trust and the Silver Trust, they can get access to it.
Yeah, PHYS for the gold and PSLV for the silver.
Yeah, and the silver premium.
Getting access meaning that they can actually take the shares and redeem it for physical metal if they choose to.
If they choose to. And as you know, the one time people might choose to is when things go extremely haywire. And you might say, hey, I want this physical precious metal in my possession rather than a piece of paper. So I see our PHYS competing with the GLD. I think it's a better instrument. When I look through those numbers and wonder how could all this physical gold be showing up, it even makes you wonder, well, maybe the GLD doesn't get the gold they're talking about. Now, I don't pretend to be an expert on the GLD, but I always wonder about the mismatch of supply and demand and how that's working out in the system.
Well, there are different buyers of gold. There's some people who actually want the tangible asset so that they have everything that tangible asset brings to the table. And there are other people who are just happy to have exposure to the gold price, the professional traders and the speculators. And to get that exposure to the gold price, they might buy a futures contract or an options contract or maybe GLD. Because with GLD, you don't really own gold. You own shares in a company that or
Right.
in a fund that's supposedly backed by gold.
And of course, the number of people that are willing to buy things electronically, as I pointed out in the silver example, I mean, it's a ratio of 800 to 1 in the sense of the trading versus the physical availability. I don't even know what the ratio is in gold, but it must be some incredible number of times the physical amount that's available that trades every day. So, and I always say, well, what are the sellers thinking? You know, what are they thinking? They know they can't deliver.
Yeah.
So,
well, isn't that a sign of the times, though? A lot of speculation, a lot of paper, and as we work our way through this financial bust, we're ultimately moving back to basics, and gold being money for 5,000 years is one of the most basic of them all.
Sure. And by the way, James, I give you credit all the time for explaining it best. And you use the words, it's a managed retreat. And that's what I think it is. You know, there's a shortage of gold. You can't let it get too emotional or parabolic. So, for example, I was very surprised to see the 2% day on, I guess it was Tuesday. It was very uncommon, even though gold should be the most emotional commodity out there, but it's the least emotion in terms of price. And I happen to be in the camp that believes that there are hands out there trying to keep it under control. They've lost the battle, but they're willing to fight lots of little wars on a daily or weekly or monthly basis. So
I'm going to be actually talking about this managed retreat in my presentation tomorrow at the GATA conference here, and explain a little bit about it. But the fundamental thing is I'm going to explain why, even though the price is high, gold still remains very, very undervalued by all historical measures.
I think the best chart, and I will show this in my presentation, is that the world has 200 trillion of financial assets, and the gold market's worth 3 trillion. And theoretically, the central banks own half of that, which is 1.5, which means investors own another 1.5 trillion, which is 0.75% of all the financial assets are in gold. Well, as you well know, there's been many times when people recommended 5 or 10% interest in gold. Somebody like me, I have almost all my money in gold. Someone like you has probably by far the biggest part of your
But investment. A lot less in the aggregate.
Yeah, but the fact is nobody's in it. And when you look at the pool of financial assets, it probably hasn't even grown in the last 10 years in the sense that the stock market's done nothing. Gold's gone up by 6 times. Well, what was the weighting in 10 years ago?
So the percentage has risen slightly, but that's because gold's price has gone up, not because there's that much more money coming into the sector. So it's 0.75% now. What is the historical norm?
I don't even know what the history. I know that many people talk about 5 or 10. In fact, I don't even think history will mean anything when people all realize they have a problem with their money in a bank or owning some government note. I mean, the demand for gold could become overwhelming. I mean, it could just be, as you predicted, and many others, it could be parabolic all of a sudden. They just realize that this fiat currency is not worth what it's made out to be. I mean, I always think of fiat currency as trust the government. I always wonder, well, why would history tell us to trust government? I mean, you'd think
given the record,
it would tell you the opposite.
Yeah.
So.
I mean, even from a diversification point of view, to mitigate risk, you need to own some gold, you need to own some silver. You have to have a tangible asset for your monetary asset, rather than just fiat based on nothing except politicians and government rhetoric.
Right.